Welcome to today's Talk Tickers Deep Dive.
Glad to be here.
So our mission today is to break down the Q2 2026 earnings call for Unifi Inc. Ticker symbol is UFI. And, we're going to translate all that dense Wall Street jargon into plain language.
Right.
Give you the cold, hard data.
No.
And deliver a clear, actionable verdict on whether this stock is a buy, a hold, or a sell.
Exactly. And for those of you tracking the ticker, Unifi is this massive global textile and synthetic yarn manufacturer. They're the company behind the Reprieve brand.
Right, the recycled plastic bottle tech.
Yeah, the technology that turns recycled plastic bottles into high-performance fibers. And they have just spent the last year navigating this, honestly, brutal gauntlet of supply chain chaos, geopolitical tariff wars, and just a massive inventory glut across the whole apparel industry.
Yeah, it's been a mess. And I got to say, as I was combing through their transcripts and the financial data for this quarter, this image just kept popping into my head.
Oh, yeah. What's that?
It feels exactly like watching a heavyweight boxer who realizes he's just, too sluggish for his division.
Okay. I like where this is going.
So he spends this grueling year doing nothing but cutting weight, just shedding all the excess, sweating it out in the sauna to drop down into a leaner, meaner weight class.
Right. Getting down to fighting weight.
Exactly. And this Q2 earnings call, this is the weigh-in. The weight is undeniably down. But the real question for your portfolio right now is, now that Unifi is in this lighter weight class, do they still have knockout power? Or, did they just starve away their muscle along with the fat?
That framework cuts right to the heart of what value investors really need to be analyzing here. Because when a company undergoes a restructuring of this sheer magnitude, the financial dashboard is going to flash some seriously conflicting signals.
Oh, absolutely. Red lights everywhere.
Right. You'll see metrics that look completely disastrous on the surface.
Yeah.
But when you strip them down to the actual operational mechanics, they are the exact results management was trying to engineer.
You have to separate the top-line vanity metrics from the bottom line sanity metrics.
I love that. Vanity versus sanity. And it is so true. We are just heavily conditioned as retail investors to look for top line revenue growth as like the holy grail.
Always. Growth, growth, growth.
But Unifi is currently executing a turnaround where less is fundamentally more.
Well, let's put those sanity metrics on the table then, because the proof of this weight cut is in the Q2 headline numbers. And the big headline is that net sales, so the top line came in down 12.5% year over year.
Which is a big drop.
It is. On any normal Tuesday, a double-digit drop in revenue sends a stock to an absolute tailspin.
Yeah, investors usually panic.
But management actively telegraphed this drop. Where this gets really fascinating is when you move down the income statement to the gross profit.
This is the crazy part.
Right. Despite selling 12.5% less yarn, their gross profit actually jumped to $3.6 million, which equates to a 3% gross margin.
And to really understand why Wall Street likes that 3%, you have to look at the baseline.
What were they at before?
In the exact same quarter, just 1 year ago, their gross profit was a mere $500,000.
$500,000. Wow.
Yeah, that was a razor-thin 0.4% gross margin. Think about that. They went from essentially trading dollars, making virtually zero profit on the actual goods leaving the factory, to generating $3.6 million in raw profit.
While the actual volume of goods sold was shrinking?
Exactly. Actively shrinking.
So the obvious question for anyone listening is, how does a manufacturing company pull that off? Because if you are running massive energy-intensive spinning machines, you usually rely on volume to absorb your fixed costs.
That is the traditional math, yes.
Right. Like the fewer spools of yarn you run through the factory, the more expensive each individual spool becomes to produce. Yet Unifi somehow inverted that math, and they didn't just do it at the gross margin level.
Yeah, they did.
They carried it all the way down to the corporate overhead.
They took an absolute sledgehammer to SG&A.
The selling, general, and administrative expenses.
Right, the corporate bloat. SG&A plummeted by 25%, down to just $9.7 million for the quarter.
That is a massive cut.
It really is. And when you combine those improved gross margins on the factory floor with a drastically lighter corporate overhead, you trigger this massive swing in operating leverage.
Okay, break that down for us.
Well, we see that swing clearly in the adjusted EBITDA, which came in at a loss of $0.7 million.
Okay, wait. A loss is still a loss. If I'm opening my brokerage app right now, a negative EBITDA number is not usually a signal to, start buying.
In a vacuum, no, of course not. But in a turnaround situation, trajectory is far more important than the absolute number.
That's a fair point.
Because that negative $0.7 million, that actually represents a $5.1 million improvement from the exact same quarter last year.
So they are inching closer.
They are standing inches away from the EBITDA break-in line. But honestly, more importantly, if you look past the accounting metrics and look at the actual cash hitting the bank account.
So free cash flow.
Yes. Their year-to-date free cash flow was a highly positive $13.3 million.
Wow. Okay, positive $13.3 million.
And they didn't just sit on it. They took that cash and aggressively paid down their obligations, slashing their net debt down to $75 million.
See, this creates a highly unusual dashboard for an investor. Your revenue dial is flashing red, right, down 12.5%, but your free cash flow dial is bright green.
Yep.
Your debt is shrinking. Your margins are expanding. I mean, it's a textbook example of a management team prioritizing sheer survival and financial health over market share.
It's prioritizing sanity over vanity.
Exactly. But I do have to push back on the core philosophy here.
Okay, let's hear it.
Because you cannot shrink your way to long-term prosperity.
Right.
Cost cutting is a tourniquet. It stops the bleeding, it keeps the patient alive on the table, but it doesn't actually heal the underlying wound.
That's a fair assessment.
Eventually, you just run out of factories to sell and headcount to trim. If your sales keep dropping 12% a year, you eventually just become a highly efficient, debt-free company with zero customers.
And that is the existential threat of literally any corporate restructuring. It's a completely valid skepticism. A tourniquet left on too long will just cause the limb to fall off anyway.
Right.
But to determine if this is a viable long-term investment, you can't just look at the fact that revenue dropped. You have to investigate the anatomy of that 12.5% drop.
Meaning what, exactly?
Management didn't just passively lose those sales to competitors. They executed a highly calculated amputation of unprofitable revenue streams and bloated infrastructure.
Okay, so let's dissect that amputation, starting with their physical footprint here in the United States.
Right.
Because you don't cut SG&A by 25% just by, flying coach and canceling the corporate retreat.
No, definitely not.
You do it by fundamentally altering how and where you manufacture your product.
Yeah.
And the centerpiece of this U.S. restructuring was the Madison, North Carolina facility.
The Madison plant was this massive piece of Unifi's legacy operations.
It was huge.
Right. But when management analyzed their capacity utilization, meaning how much of the factory was actually running versus just sitting idle, they realized they were carrying a crushing amount of excess weight for the current demand environment.
Because keeping a massive textile plant open when it's only running at, 50% capacity, that just destroys your margins.
It absolutely destroys them.
Yeah.
Because you are still paying for all the real estate, the climate control, the maintenance, the baseline labor force. It's a massive drag.
So they made the call.
They made the agonizingly pragmatic choice to just shut it down and sell the facility outright to a third-party buyer.
And the price tag on that sale was $45 million. And honestly, the capital allocation decision they made with that $45 million tells you everything you need to know about the current mindset of this executive team.
It really does. What did they do with it?
Well, they didn't authorize a shiny stock buyback to temporarily juice the share price. They didn't issue a special dividend to placate impatient shareholders. They took every single dime of that capital and immediately deployed it to deleverage the balance sheet.
And that discipline is exactly why the net debt sits at a highly manageable $75 million today.
Right.
But, the operational challenge of selling a factory is that you still have orders to fulfill. You can't simply stop spinning yarn.
So where did the work go?
The transition strategy was to move the production load from Madison over to their facility in Yadkinville, North Carolina. And this wasn't just a one-to-one transfer of old machines into a new building.
No, the Yadkinville plant is totally different.
It is heavily indexed toward modern automation.
And this is where the human cost of a turnaround intersects with the financial reality. By migrating the production volume into a highly automated environment, they drastically increase their labor productivity per pound of yarn produced.
But the brutal math of automation is that it replaces human hands.
Yeah. This consolidation resulted in a staggering 25% reduction in Unifi's U.S. headcount.
It is a harsh reality. But from the perspective of a shareholder evaluating the viability of the business model, the financial impact of that consolidation is what creates the pathway to survival.
Right.
On the earnings call, the CEO, Eddie Engel, dropped a figure regarding the result of this restructuring that honestly completely resets the investment thesis for Unifi.
I know exactly the number you're talking about.
Because they shed Madison real estate, reduced the headcount by 25%, and maximized the automation at Yadkinville, management estimates they have lowered the company's annual revenue break-even point by roughly $125 million.
$125 million reduction in the break-even threshold.
It's staggering.
If you are looking for the aha moment of this deep dive, that is it. Their new break-even point sits at roughly $575 million in annual revenue.
That is operating leverage in its purest, most aggressive form.
It really is. It's the equivalent of like a restaurant managing to negotiate their rent down by half. Suddenly, they don't need a line around the block every single night just to keep the lights on.
That's a great analogy.
If Unifi's break-even was hovering around $700 million and they're only pulling in $600 million, they are bleeding cash and dying a slow death.
Right.
But by taking a machete to those fixed costs and lowering the floor to $575 million, that exact same $600 million in revenue suddenly transforms them into a profitable enterprise.
Exactly.
They don't need a miraculous macroeconomic boom to survive. They just need to maintain a very achievable baseline.
The math of the business has just been fundamentally rewritten. The chief financial officer, A.J. Eckert, actually broke down the mechanics of this new $575 million threshold during the Q&A segment with analysts.
What do you say?
Well, to hit that zero operating income baseline, they don't need explosive growth. They need the Americas segment to generate in the mid to high 300 millions in revenue.
Okay.
While the Asia and Brazil segments simply need to maintain their current historical run rates. If they hit that specific geographic mix, it yields a high single-digit consolidated gross margin, which is more than enough to cover the newly streamlined overhead.
Okay, so the U.S. operation got lean and mean. But Unifi is deeply exposed to global macroeconomic currents. We have to look at the rest of the world because the U.S. restructuring doesn't explain the entirety of that 12.5% revenue drop.
No, it doesn't.
The earnings call highlighted severe turbulence in two major international markets, Brazil and Asia.
Yeah.
Let's look at the Brazilian market first, because the earnings call cited something they politely called, and I quote, pricing pressures associated with lower competitive prices and imports from Asia.
Yeah, lower competitive prices is the sanitized Wall Street translation for a deeply aggressive geopolitical economic tactic.
It's corporate speak.
Exactly. Later in the call, the CEO actually dropped the corporate speak and accurately referred to it as dumping from Asia into Brazil.
Dumping. Okay, break that down for us. What does that actually mean in this context?
To understand this, you really have to understand the massive scale of the Chinese synthetic yarn industry. China has these enormous, often state-subsidized polyester manufacturing plants.
Huge scale.
Massive. And when domestic demand within China slows down, which it has significantly, those factory operators do not simply turn off the spinning machines.
Because they can't.
Right. The economic and political cost of shutting down plants and laying off thousands of workers is just too high for the government to tolerate. So they keep the machines running at full capacity, creating a massive oversupply of synthetic yarn.
And when you have millions of pounds of excess yarn that nobody in your home country wants to buy, you have to get rid of it somewhere.
Precisely. You flood the international markets. And because they are desperate to move the inventory, they sell it at rock bottom prices.
So they're taking a loss, right?
Often below the actual cost of production. And Brazil is a massive textile and apparel manufacturing hub, making it a prime target for this dumped inventory.
So Unifi gets caught in the crossfire.
Exactly. When a flood of dirt-cheap Chinese polyester hits the Brazilian market, Unifi is trapped. If they want to maintain their market share and keep their Brazilian customers, they're forced to slash their own prices to match the dumped goods.
Which just absolutely eviscerates their gross margins in that region.
It becomes a brutal race to the bottom.
And it is a race where the winner just ends up bankrupt. But management noted a recent shift in those headwinds, didn't they? They aren't just sitting there taking the hits.
No, the macro environment actually started shifting in the weeks leading up to the earnings call.
What changed?
A few things. The Brazilian real strengthened against the dollar. Global oil prices ticked upward, which, remember, raises the raw material cost of making polyester.
Right.
And most importantly, the sheer financial pain of dumping finally forced some of the most inefficient, lowest-tier manufacturing assets in Asia to actually shut down their lines.
The pain got too high even for them.
Exactly. And that subtle reduction in the flood of cheap yarn allowed baseline pricing in Asia to creep back up, which instantly relieves the pricing pressure in Brazil. It is an incredibly delicate domino effect.
So Brazil is essentially collateral damage in a global manufacturing war. But what about Unifi's actual operations inside Asia? Because the data from the Asia segment looks completely contradictory.
It really does.
Net sales in Asia plummeted by an astonishing 27%. You lose more than a quarter of your revenue in a single region, you expect a bloodbath on the bottom line.
Right, you'd expect them to be hemorrhaging cash.
Yet, the gross margin in the Asia region actually expanded by 260 basis points year over year. How does a manufacturing company lose 27% of its sales volume and end up significantly more profitable?
It comes down to a radical difference in operational architecture. In the United States, Unifi operates on an asset-heavy model.
Like we talked about with Madison and Yadkinville.
Exactly. They own the real estate, they own the massive polymerization equipment, they employ the technicians directly. That creates immense fixed costs. But in Asia, they deploy what management refers to as an asset-light model.
Asset-light.
Yeah. They do not own massive footprint factories outright. Instead, they partner with existing regional manufacturers, utilizing third-party capacity to spin their specialized yarns.
Oh, I see. So when the macro environment softens and orders dry up, Unifi isn't the one stuck paying the mortgage on an empty factory.
Exactly. The asset-light model transforms fixed costs into variable costs. When demand drops 27%, Unifi simply scales back their utilization of those partner facilities.
Their costs drop almost perfectly in tandem with their revenue.
Because they aren't paying for idle workers or climate control in an empty warehouse. But the margin expansion wasn't just a byproduct of variable costs. It was actively driven by a strategy the CEO called bottom slicing.
Bottom slicing. That is one of those concepts that sounds simple but requires ironclad discipline from a management team.
It really does.
It's basically the practice of intentionally firing your worst customers.
That's exactly what it is. It's looking at your order book and identifying the clients who demand the absolute lowest prices, eat up your capacity, and yield virtually zero profit.
Which, in an oversupplied market, buyers have all the leverage, right? So they will demand rock-bottom pricing.
Always. And the natural instinct of a desperate company is to accept those bad orders just to keep the revenue numbers looking high for the quarterly report.
To protect the vanity metrics.
Right. But Unifi did the opposite. They looked at those low-margin, high-volume orders and simply walked away.
Which completely explains the 27% top-line plunge. They actively chose to let that revenue disappear.
Because the revenue they retain, the top slice of the pie, was their premium high-margin product. When you strip away the low-margin bulk, your overall gross margin percentage naturally spikes upward.
So expanding margins by 260 basis points while losing 27% of your volume, that is the hallmark of a management team that is prioritizing cash flow reality over top-line vanity.
It is the ultimate flex of financial discipline.
It is. But we keep coming back to the same immutable law of business. You can build the most efficient, disciplined, asset-light, low-break-in machine in the world. But eventually, you have to put gas in the engine.
You gotta sell yarn.
You have to drive new sales. Which brings us to a really fascinating element of Unifi's strategy to actually stimulate that demand.
The marketing side.
Right. Because if you are an investor looking at a B2B manufacturer, a company that sells schools of synthetic yarn to textile mills, you do not expect to hear them dedicating a massive portion of their earnings call to consumer-facing fashion marketing.
It feels very out of place.
But Unifi is heavily reliant on an ingredient branding strategy for their Reprieve and TrueTemp 365 technologies.
Ingredient branding. That is basically the Intel Inside strategy applied to the apparel world.
Perfect comparison.
Unifi knows that generic, unbranded polyester is a race to the bottom commodity. The only way to command a premium price and protect your market share is to make the end consumer specifically demand your product.
Because if a shopper walks into a store and actively looks for the green Reprieve tag on a pair of leggings because they want recycled, sustainable materials, the clothing brand is forced to buy their yarn from Unifi.
Exactly. It creates a consumer pull that entirely bypasses the traditional B2B supply chain friction.
And the call highlighted a relentless barrage of these co-branding partnerships. The sheer diversity of the brands involved really illustrates how deeply integrated Reprieve has become.
They listed off quite a few.
They did. They launched a hot swap denim collaboration with Dovetail Workwear, which is a major U.S. women's workwear brand, utilizing both the recycled Reprieve yarn and Unifi's TrueTemp 365 climate control tech.
Nice.
They partnered with the outerwear brand Save the Duck, integrating Unifi's Thermaloop insulation. They had a Spanish brand, Algonzo, installing massive Reprieve physical signage directly onto their retail sales floors.
That's huge visibility.
You had winter wear with Obermeyer, outdoor gear at REI, bedding with Sealy, and furniture integration with Brentwood Home. They even had an avant-garde designer, Dario Mittman, feature Reprieve fabrics on the runway at Sao Paulo Fashion Week.
That is a wild spread. From Sealy mattresses to Sao Paulo runways.
Right. But the CEO was highly transparent about the direct ROI of these events, because a runway show in Sao Paulo does not immediately translate into a purchase order for 3 million pounds of yarn.
Of course not. That is not the objective.
What is the objective?
The objective is strategic cultural positioning. It reinforces the narrative to massive global retailers that sustainability is not a passing fad. And it firmly anchors the Reprieve brand in the consciousness of young, influential consumers and designers.
So it's a defensive play.
Definitely. By keeping the brand highly visible at the consumer level, Unifi builds an invisible moat around their market share, defending against that flood of cheap, unbranded Asian polyester we discussed earlier.
You build the moat with marketing, you lower the drawbridge with the $575 million of break even, and you defend the castle with the asset-light model. The structural turnaround is completely in place.
The foundation is there.
But to know if this stock is actually going to move, we have to look at the forward guidance. We need to know if the macroeconomic environment is actually going to supply the demand needed to clear that $575 million hurdle.
Right, and to accurately forecast the future demand, we really have to understand the specific trauma the supply chain just endured over the past 2 years.
The great inventory glut.
Exactly. The executive chairman, Al Carey, provided some invaluable context regarding the timeline of the industry's collapse. It all traces back to the lingering threat of massive geopolitical tariffs.
Right, everyone was scared of import taxes.
Anticipating that international trade was going to become punitively expensive, global apparel brands and major retailers just panicked. They engaged in massive, unprecedented over-ordering to get product manufactured and imported into domestic warehouses before the new tariffs could take effect.
It is the classic bullwhip effect.
Oh, perfectly stated.
Think of it like a traffic jam on the highway. A consumer at the front of the line taps their brakes slightly. The retailer behind them slams on the brakes. The wholesale distributor behind them swerves into the ditch.
Right.
And by the time the signal reaches the raw material manufacturer at the back of the line, it's a 10-car pileup.
And the pileup in this scenario was a historic mountain of inventory sitting stagnant in retail warehouses.
Just dead stock.
Because those warehouses were stuffed to the absolute ceiling, the retailers completely halted new purchase orders. This triggered a brutal, industry-wide 7-month destocking phase.
7 months of nothing.
Nobody was buying yarn because they were desperately trying to sell off the mountains of t-shirts and leggings they already owned. Unifi was essentially starved of demand while the industry digested its own panic buying.
But according to the guidance on this call, that digestion phase is officially over.
Carey pointed to the holiday season data as the turning point. Holiday apparel sales were up roughly 4%.
Which isn't crazy, but...
Right, it isn't a historic roaring boom, but it was enough to finally flush that excess inventory out of the system. The destocking phase is done. The warehouses are finally empty, which means the ordering cycle has to restart.
Okay, so this brings us to the most counterintuitive piece of guidance for Q3. Management explicitly warned investors that they will see a dip in operating cash flows in the upcoming quarter.
Yes, they did.
Which sounds terrifying. We just spent the first half of this deep dive praising their $13.3 million in positive free cash flow. If they're about to burn cash in Q3, how does a value investor look at that as anything other than a massive red flag that the turnaround is failing?
Because of the mechanics of working capital, if you understand the manufacturing cycle, that cash flow dip is actually a highly bullish indicator.
Explain that.
It is the direct financial footprint of returning demand. Think about it like this. You have to buy the flour before you can bake and sell the bread. Right now, Unifi is buying a massive amount of flour.
Because the retailers are finally calling them back with new orders.
Exactly. To fulfill those incoming orders, Unifi has to purchase raw materials, the recycled PE flake. They have to pay for the energy to run the extruders. They have to pay the workforce in Yadkinville to spin the yarn. They have to build up their own internal inventory of finished goods before they can ship it to the customer and collect the invoice. They are temporarily spending their cash reserves to build the product.
So a dip in cash flow means they are busy.
Yes. If their cash flow remained perfectly high and stable, it would actually indicate that their machines were sitting idle and no new orders were coming in. The CFO characterized it perfectly as a moderate increase in working capital spent to support disciplined inventory builds. It is literally the sound of the engine firing back up.
Okay, so the engine is running and the working capital is flowing. But where is the long-term fuel going to come from? Because the most compelling piece of macroeconomic guidance in this entire earnings call has nothing to do with consumer trends or holiday shopping.
Well, it has to do with geography.
Exactly. It has to do with a massive tectonic shift in global trade routes. We have to talk about the nearshoring catalyst.
This is the macro tailwind that could define Unifi's growth trajectory for the next decade.
It's that big.
It really is. Major U.S. retailers and apparel brands are fundamentally exhausted by the volatility of Asian supply chains. The dumping, the unpredictable tariffs, the 2-month ocean freight lead times, the geopolitical friction. It is just too much risk.
They want out.
They want their supply chains pulled closer to home, where logistics are measured in days rather than months, and the regulatory environment is stable. This is the whole concept of nearshoring, and the absolute epicenter of nearshoring for the textile industry is Central America.
And Unifi just received a massive government-level assist in that exact region. The CEO noted that just a week prior to the earnings call, El Salvador and Guatemala signed reciprocal tariff deals with the United States government under the framework of CAFTA-DR.
CAFTA-DR, the Dominican Republic Central America Free Trade Agreement. It is the lifeblood of textile manufacturing in the Americas. And to understand why this is a catalyst for Unifi, you have to understand a crucial piece of trade legislation known as the Yarn Forward Rule.
The Yarn Forward Rule. Break that down.
Think of the U.S. border as a highly exclusive VIP club with a massive cover charge called an import tariff. If a major clothing brand wants to get their apparel into the club without paying the cover charge, they have to use the VIP back door. But the Yarn Forward Rule dictates that to use the back door, the garment must be assembled in a CAFTA-DR member country. And critically, the yarn itself must originate from the U.S. or a member region.
So a brand cannot simply buy dirt cheap, subsidized yarn from China, ship it across the Pacific to Guatemala to be sewn into a cheap t-shirt, and then ship it to Miami expecting duty-free access.
Exactly. The U.S. customs officials will look at the origin of the yarn and hit them with the full tariff.
So the Yarn Forward Rule basically forces the supply chain to utilize regional materials.
Precisely. And the recent tariff agreements with El Salvador and Guatemala effectively rubber stamp and streamline this process. The CEO stated clearly that apparel made from retail yarns manufactured in these countries can once again receive seamless CAFTA-DR duty-free treatment.
That is a huge advantage.
If you are a massive U.S. brand trying to nearshore your operations away from Asia, you are forced to source your yarn from a company that has massive scale and existing infrastructure within the Americas. Unifi is sitting right in the center of that geographic sweet spot. It is an immense, legislatively mandated competitive moat.
It is the ultimate right place, right time scenario for their Americas division.
It really is.
But management is also acutely aware that relying entirely on the whims of the fashion and apparel industry, even with a near-shoring advantage, is a volatile existence. Consumer spending drops the second inflation ticks up. Trends change overnight.
Fashion is fickle.
Highly fickle. So, to build true resilience, Unifi is actively attempting to diversify their revenue streams entirely outside of the closet. They dedicated a significant portion of the call to what they label beyond apparel growth.
Diversification is the final pillar of a mature turnaround. The CEO noted that their packaging division had a highly robust quarter. They are seeing incremental growth in carpet. They're exploring deep integrations into automotive applications.
But the most highly scrutinized and potentially lucrative sector within this beyond apparel push is their pursuit of military and tactical contracts.
Yes. The military commentary was fascinating because of the timeline.
Right. The CEO admitted they did not secure significant actual production orders for the military in Q3. Instead, they are locked in a massive ongoing phase of sampling and testing, projecting that actual revenue won't start flowing until fiscal Q4 at the earliest.
And the executive chairman, Al Carey, specifically jumped in during the analyst Q&A to hammer this point home. He told the analysts directly to, quote, watch military in the next couple of quarters. It looks like it's bigger than expected.
And Carey followed that up by explaining the sluggish timeline, noting simply that it just takes a long time to test for durability and colors.
Which is an understatement.
I really want to unpack that because to a casual observer, testing a color sounds like it should take about 5 minutes. No. You dye the yarn green, you look at it, it's green, boom, done. Why does military testing take years?
Because the performance parameters are a matter of life and death, not aesthetics.
Wow. Okay.
If a consumer buys a fast fashion t-shirt and the color fades after 10 washes, they might leave a bad review and buy another one. If the military procures a tactical uniform, it has to perform under absolute extremes.
So what does color testing actually mean for the military?
The color testing Carrie mentioned isn't just about looking good, it's about near-infrared, or NIR, compliance.
NIR.
Yes. The yarn has to be dyed and treated so that it absorbs and reflects infrared light in the exact same spectrum as the surrounding natural environment. If the dye formulation is off, a soldier wearing that uniform will literally glow bright white when viewed through enemy night vision goggles.
Oh, wow. That puts durability testing into a whole new perspective.
Completely. They are testing tensile strength under extreme abrasion. They are testing melt point parameters to ensure the...
It's hardcore engineering.
Exactly. Unifi has to develop the highly specialized yarn, provide the samples, and then wait while the military weavers create the fabric, cut the garments, and subject them to months of literal destruction testing in the field.
But the flip side of that agonizing multi-year testing gauntlet is the financial payoff at the end. The barrier to entry is massive, but once you clear it, you are effectively entrenched.
It creates incredibly sticky revenue. The Department of Defense does not want to endure a 2-year NIR and abrasion testing process with a new, unproven supplier just to save 3 cents a yard on generic polyester.
No, of course not.
Once Unifi's specific yarn is spec'd into a master military contract, they become the locked-in supplier for the life of that contract. It provides a highly lucrative, high-margin revenue floor that is completely insulated from consumer recessions, holiday shopping misses, or shifting fashion trends.
It is the ultimate anchor for a volatile manufacturing business.
It really is.
Well, we have analyzed the core data. We have dissected the mechanics of the U.S. factory closures, the bottom slicing in Asia, and the massive $125 million reduction in their break-even threshold.
We covered a lot of ground.
We did. We explore the working capital dynamics, the CAF-to-DR nearshoring tailwinds, and the high-stakes military testing. We have every piece of the puzzle on the table. So now it is time to deliver on the core mission of this deep dive.
Let's do it.
As an analyst evaluating Unifi, Inc., ticker symbol UFI, coming into this Q2 2026 earnings call, what is your actionable verdict? Are we bullish, bearish, or holding?
Synthesizing the totality of the operational restructuring and the macro guidance, I am taking a clear, opinionated stance. This is a cautiously bullish signal.
Cautiously bullish.
Yes. However, that bullishness requires strict qualification. This is not a high-flying momentum tech stock that is going to double in 3 weeks.
Definitely not.
This is a deeply unloved, gritty manufacturing company that has just successfully executed the absolute hardest, most painful phases of a corporate turnaround. My bullishness is rooted entirely in the margin of safety they have created.
The downside risk has essentially been surgically removed.
Exactly. The heavy lifting is done. They took the brutal medicine of selling the Madison plant to slash their debt down to a highly secure $75 million. They executed the 25% headcount reduction to transition to an automated footprint in Yadkinville.
And the bottom slicing in Asia.
Right. They enforced the discipline of bottom slicing unprofitable revenue in Asia to protect their margins. All of this resulted in lowering that revenue breaking threshold down to $575 million. They have built an incredibly resilient, efficient machine, and they are sitting perfectly positioned to catch the macro wave of nearshoring to Central America. The structural foundation for profitability is undeniably solid.
Okay, I hear the structural bull case and the math on the break-even threshold is incredibly compelling, but I am going to step in here and throw a bucket of cold water on the timeline.
Okay, let's hear the bear case.
Because I see a very clear, non-negotiable hold condition for this stock. Management deserves a standing ovation for step 1, aggressively cutting costs and engineering efficiency. But efficiency alone does not scale a business. For a stock price to break out, you eventually need upside momentum.
Right, you need growth.
And step 2, actual top-line revenue growth has not fully materialized yet. The revenue was still down 12.5%.
It remains a show-me story for the top line.
Precisely. If I'm an investor allocating capital today, I am buying the premise of the turnaround, but I am holding management strictly accountable to the next 2 earnings reports. I need to see the destocking phase actually translate into hard purchase orders.
You want to see the invoices.
Exactly. I need to see the Q3 working capital investment turned into shipped product. I need the Central American CAF-to-DR tariff deals to generate actual revenue. Management stated they need the Americas segment to hit the mid to high 300 millions in revenue to achieve their optimal margin mix.
Yep, that's the target.
If we get to Q3 and Q4 and that top-line revenue is still shrinking or trading flat, all of these brilliant cost cuts will simply be treading water. Management built a beautiful, highly tuned engine. Now they have to prove they can actually find the gas to run it.
That is the perfect encapsulation of the risk profile. The downside is protected by the balance sheet, but the upside requires the macro environment to finally cooperate. It is a stock that demands patience and strict monitoring of those quarterly revenue figures.
Which brings us to the close of our analysis today. But before we sign off, I want to leave you with a final provocative thought to mull over. Something that builds on the margins of this earnings call, but points to a massive, glaring contradiction in the broader apparel industry.
Oh, this is a good one.
Throughout the transcript, management briefly touched upon their advanced circular textile innovations, specifically their textile take-back and Thermaloop programs. These are initiatives designed for true textile-to-textile recycling.
Which is amazing tech.
It is. Taking old, discarded garments, breaking them down at the molecular level, and skinning them into brand new yarn.
It is the absolute holy grail of the sustainable fashion movement. A truly closed loop.
And yet, the CEO explicitly, almost begrudgingly, admitted that the commercial adoption of these circular products has been slower than anticipated.
Which is so telling.
Right. He pointed out that European governments are actively drafting legislation to force companies to adopt circular solutions. And we know that fashion brands absolutely love to slap the Reprieve name on their hang tags for the PR boost.
They love the marketing.
But the actual financial adoption, the willingness of these multi-billion-dollar apparel brands to reach into their pockets and pay the slightly higher premium for true circular recycling, is lagging miles behind their eco-friendly marketing campaigns.
It's greenwashing versus actual capital allocation.
Exactly. So I ask you to consider the reality of the market. When will the fashion industry's wallet actually match its relentless sustainability marketing? Everyone wants to post on Instagram about saving the planet, but when the purchase orders are drawn up, the industry is still hesitant to abandon the cheap, linear supply chain.
They still want the cheap stuff.
But here is the massive asymmetric upside for Unifi. If, or perhaps when, international government regulations finally drop the hammer and force that shift, ending the era of disposable fast fashion, Unifi already has the physical infrastructure and the technology fully operational.
They are ready to go today.
They built the solution before the market was legally forced to buy it. Will that early, massive capital investment pay off as a visionary masterstroke, or would they be left waiting forever for a cutthroat industry to do the right thing?
It is a fascinating question about the intersection of corporate ecology, government regulation, and raw bottom-line capitalism.
It really is. We started this deep dive talking about a heavyweight fighter who spent a year in the sauna cutting weight. Unifi stepped on the scale, and the numbers don't lie. They made weight.
They certainly did.
They are lean, they are focused, their balance sheet is fortified, and they are ready for the next round. Now, as investors, we just have to wait for the bell to ring to see if the market is actually ready to fight.
Well said.
Thank you for joining us on this deep dive into Unifi's Q2 earnings. Remember to check the facts, mind your portfolios, and always stay curious. We will catch you on the next one.